Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. This video is the third in my 5-part series on the company BHP. Today we're going to be talking about the company's balance sheet. The thing to think about with a balance sheet, most investors don't spend a lot of time focusing on it. I think it's really important. One of the two reasons why I think it's important is occasionally you'll find a company which is a solid investment based on nothing but its balance sheet. The company would be trading at or below its book value, or better yet, at or below its net working capital. And in those cases, you're really getting all of the upside of the performance of the company for free. And in the long run, the company typically will trade for at or above those numbers. So that's one good reason to do it. The bigger and better reason to look at the balance sheet is with a solid company, the easiest way for that company to get in trouble is to simply have too much debt. If they have too much debt, then they have too much interest payments. And when things turn bad, which they occasionally will, those interest payments can really cause a lot of stress and gobble up the company. What's worse is now that we're seeing interest rates rising for the first time, the carry cost of that debt is going to start to increase, and that's going to really reduce the amount of profit. So even though the company might be doing better operationally than they did last year, they're going to generate less profits because their interest rates are going up. And the result of that is you want to be paying attention to the company's cash on hand and the company's debt on hand and what's happening over time with those things. Ideally, the cash on hand will be increasing over time and the debt will be decreasing over time. So let's take a look at the company BHP through that prism. The first thing that I always look at when looking at the balance sheet is the cash on hand. So, and when I say cash, I mean cash on marketable securities. So in 2011, this company had about $5 billion in cash on hand. Today it has about $15 billion in cash on hand. So that's that's tripling the amount of money that they've got in reserves over a period of 10 years. That shows that lots of really good things are happening at this company, and happening over a good period of time. So that obviously gives you real comfort that, okay, this company seems to be generating cash flow. And again, we haven't looked at all the other numbers yet, but they seem to be able to sustain a nice cash balance and grow it over time. Before I go any further, I have just 3 things to talk about. The first thing is, if you want to get more information from me, you can follow me on Twitter. The handle is @RobinsonStocks. If I see an article that I like, oftentimes I'll post that information there, or just information on the investing. So feel free to follow me. Also, like everybody else on YouTube, looking for subscribers, about 427, like to get to 1,000. That's when I can start to monetize this account. And just for my own personal edification, I'd love to know where my subscribers are following me from. So just drop a line in the comments letting me know what city and country you're from so I can put a dot on this map. Thanks. The next thing that I look at when looking at a company's balance sheet is its current assets and current liabilities. So to be sure you understand the definitions, current assets is money that you have or will have in receivables in the next 12 months, and current liabilities is money that you either currently owe or will owe in the next 12 months. And what I like to see is that there's a gap, a favorable gap, where there are more current assets than there are current liabilities. That means the company always has them cash on hand, at least for the next 12 months to pay all their bills. And you can see that that number is pretty solid for this company. It has been since about 2013. And so we're very comfortable that the current assets for this company are great. Again, they have about $20 billion in current assets and about $15 billion in current liabilities. So very nice gap between those two numbers. Another way of looking at that same piece of information is the current ratio. The current ratio is the relationship between current assets and current liabilities. And so when looking at that, this chart looks at the top 10% of companies have a current ratio of about 4 times earning, about 4. That means they have $4 of current assets for every dollar of current liabilities. The top 25% of companies are closer to 3, and the bottom 25% of companies are about 1. So this company is pretty average in current liabilities. So that's pretty okay. And the reason that I say that is, if a company has too much money in current ratio, that just means they have a lot more money in current assets than they really need. And at some point, they should be looking for ways to give that money back to us as the shareholders. Obviously, you don't like to see that number get too low because then you don't have a buffer for the bad times. Different industries have different abilities to sustain a tighter margin in current ratio. In general, this company is pretty average in current ratio. And so again, I'm comfortable with that. This company doesn't need, in my opinion, a tremendous number of reserves relative to their current liabilities. This chart looks at the total amount of debt that the company has, both in terms of current liabilities and long-term debt. You can see that in 2015, this company had about $30 billion in debt. Today they have about 15. This shows that they have about 18, but they've actually paid about $2 billion of debt off this year as well. That doesn't show up in this annual number. That's spectacular, right? So you've paid off $15 billion in debt in 7 years. As an investor, that means that, so we've seen during that period of time, we watched the cash on hand triple from 5 to 15 billion, and we've watched the debt go from about 30 billion to about 15 billion. So that's about a $25 billion difference in the balance sheet just over the last 7 or 8 years. That's phenomenal. That's a really strong sign that we really like this company. And so that's the other thing that is very interesting here is, generally speaking, current liabilities will increase with revenues. As the company's making more money, it takes more money to make money. So they have more employees and they have more facilities and they have more equipment that they're buying and that they owe money on at any given time. And so generally speaking, as the current, as revenues are going up, you'll see current liabilities go up. In this company, the current liabilities peaked in 2011, and while they've been going up the last couple of years, the current liabilities as a percentage of revenues and as a percentage of profits has been fantastic for this company. And this is an indication that this company, from a financial standpoint, is extremely well managed and also is pretty profitable because they have the money to do these things. So this chart, the next thing I look at is interest expense. One of the biggest reasons why I care about the debt that a company has is because debt generates interest expense. It's an obligation to pay the money back to the bank, with some profits for the bank or the profits for the bondholders. What's fascinating about this chart is that it's so topsy-turvy that generally you would expect this to be much more flat. So I'm not sure where they're borrowing the money or how they're borrowing the money that is causing these significant gyrations in income and interest expense. It's not important. The amount of money isn't significant to the operations of the company, so I haven't really dug deeply into it. I just find it interesting. Again, normally this chart would be much more smooth than it is. The next chart is interest expense, also looking at interest income. Sometimes when a company has $15 billion in the bank, they've used that money to create some profits, and that is a net offset against interest expense. That isn't really happening here. They're not making much money off of their interest income, and certainly not enough to offset the interest expense. Even though they have about 15 billion in cash and about 15 billion in debt, if this company had a better asset allocator managing that $15 billion of cash, I'd like to see better results there. That's pie in the sky. Not every company's going to have that. It just would be nice if they did. So we talked about how topsy-turvy the interest payment obligations were for this company. That doesn't give you any context. That doesn't tell you what that interest is in relation to the income of the company. The interest coverage ratio does that. It tells you how much money they're making relative to how much money they owe. And, I like to see a minimum interest coverage ratio of about 1.5%. So if a company doesn't have 1.5 times the earnings or 2 times the earnings that they need to pay their interest, I get very nervous. But this company is close to 30 times and even at 15 times has a tremendous buffer. They have lots and lots of profit to pay their debt, which leads me to believe that debt for this company, while $15 billion is a lot of money, it's not a lot of money relative to the operations of this company. Again, I'd love to see the debt number get down to 0, but if they never do that, I'm not going to lose sleep about it. And this is one of the areas that I'm really concerned about. I think what we're going to start seeing is interest coverage ratios decreasing dramatically, maybe even getting to 0, because I believe we're going to see interest rates going from 4 or 5% for companies to finance their money to 8 or 9%. And if you have too much debt relative to your income, that's going to be catastrophic to this interest coverage ratio for a lot of companies. Another context that I try and use in terms of looking at long-term debt is how long would it take us to pay it off if we made that our primary focus? If we said, look, interest rates are gone too high, we just need to get rid of all this debt. How long would it take to do that? And I like to see about 3.5 years to 3 to 3.5 years to pay off all of our debt. If we've got much more debt than that, it tends to be possibly problematic. This company has been below that red line for the last 3 years, and it's been below it for really all but 2 or 3 years out of the last 20. So pretty comfortable that this company's debt load is not significantly above where it needs to be for a company with this kind of earning power. Yet another way to look at interest expense, and again, I spend a lot of time looking at interest expense because I believe that's the thing that can really tank a company that would otherwise be great during the really bad times. So another way that I look at interest expense, and I want to get a sense of how significant the interest expense is to the way the company is run, is by looking at interest expense as a percentage of operating income. And you can see here that I like to have no more than 15% of operating income going to interest expense. This company, with the exception of 1 year, has been below that number for quite a period of time. And so therefore, I don't believe interest expense is the kind of thing that's going to cause a tremendous amount of trouble for our company in terms of our profitability. Yet another way to look at debt is in relation to the equity of the company. So we like to have debt as low a portion of our debt. Our debt to equity ratio, we want that number to be as low as possible. Lower is better. The red line here represents the top 10% of companies that I've analyzed. The green line is the top 25% of companies that I've analyzed. So this company's debt to equity ratio is in the range of being in the top 25% of companies. So again, very, very solid. So that pretty much does it in terms of the balance sheet for this company. The balance sheet for this company is very, very strong. And more importantly, it seems to be getting stronger every year. They've increased the amount of cash, tripling it over the last 7 or 8 years. They've cut the amount of debt that they owe by more than 50% over a 10 or 11 year period of time. They've got plenty of, the debt to equity is low. The interest coverage ratio is high, which we like to see. The years to pay off debt is in a manageable margin. And so there's nothing here in this company's balance sheet that would lead me to believe this company is anything but a solid investment. So thank you very much for your time. Again, I'm James Robinson. I manage money for a living, and I'd love to hear from you if you think you might need some help managing your money. Thank you.